Hello, everybody. All right, so our lecture will be on fiscal policy and taxes. All right, so if we remember, we said government policy to influence the economy can be divided into two: monetary policy and fiscal policy. All right, so we said monetary policy involved using the interest rates and money supply to influence the level of economic activity. For instance, if the government increases the interest rates, then people will put their money in banks as opposed to spending them or engaging in economic activities, and that would reduce the amount of economic activities in the economy. If the government wants to speed up the economy as well, they can print more money. Okay, and if they want to slow down the economy, reduce the level of economic activities, once again, they can reduce the money supply. So monetary policy has to do with both interest rates and money supply to influence the level of economic activity. We said fiscal policy had to do with taxation and spending. For instance, if the government wants to reduce the economic activity um, by firms, what they could do is they could increase taxes on firms, and then firms will have less money to spend, and that will reduce economic activities. Same goes for households, same goes for consumers in the economy. So increase taxes, that should reduce the level of economic activity. You could also use that to control inflation, for instance, okay, if you want people to spend less. And we said level of government spending as well. So if the government wants to speed up the economy, the government could spend more money, right? So maybe spend more money on the NHS, on bridges, on hospitals. Then they have to hire people. People need to do this construction work or whatever it is the government is doing, and that would also speed up the economy. Okay, so government policy can be divided into monetary and fiscal policy. Okay, and monetary policy further can be divided into interest rates and money supply. Fiscal policy can be further divided into taxation and spending. For now, let's focus on fiscal policy. So fiscal policy can be used to influence aggregate supply and demand in the economy. So like I said, the government increases taxation, that should reduce aggregate demand in the economy, right? And if the government increases taxation, the opposite should happen. And if government spends more money, that should increase aggregate demand. That's also might be a supply side policy, right? So you can use fiscal policy to both influence aggregate supply and aggregate demand. Now, the formal definition of fiscal policy is this: fiscal policy involves the use of changes in government spending and the taxation and benefit systems to influence the economy. Okay, so government spends more, the economy should speed up, there should be more activity. Government spends less, there should be less spending, less activity. Government taxes more, that should slow down the economy. If the government reduces the benefits for people, makes it less attractive to be on benefits and more attractive to work, that should also affect the aggregate supply. All right, so the purpose of fiscal policy could be to influence aggregate supply and demand, okay, like we've explained already, or to correct a fundamental disequilibrium, okay, say in times of recession, for instance, the government could reduce taxation or to increase spending, okay, or maybe mess around or play around or do something to the benefit system, okay, or maybe just to fine tune the economy to make things smoother, okay. So fiscal policy we can use to do all these things. So what does the government typically spend on? Your typical government spends on defense, the army, the navy, the air force, the marines, if you're American, social security benefits, okay, unemployment benefits, disability benefits, education, or repayments on previous borrowing, okay, so maybe servicing the national debt. So let's talk about taxes. What is a tax? A tax comes from the Latin word taxo. It is a financial charge or other levy imposed upon a taxpayer, an individual or legal entity, by a state or the functional equivalent of a state to fund various public expenditures. Okay? Failure to pay or evasion or resistance to taxation is usually punishable by law. All right? Now, the two sides of this, all right, tax evasion and tax avoidance. Okay, tax avoidance is sort of getting around taxation in a legal way. Okay, so tax avoidance, you know, you're being legal, you're being smart about this. Maybe you hire lawyers and they reduce your tax incidence. Okay, so that's good. On the other hand, tax evasion, that is illegal. Okay, so you refuse to pay, or you forge your documents, or you do other illegal activities to reduce your tax burden. Okay, or maybe to just get out of paying taxes altogether. Tax evasion is illegal. Tax avoidance is legal, but tax evasion is legal. So note the difference. Now we can move on to talk about taxation systems. There are three main taxation systems around the world. The first is a progressive taxation system. The second is a regressive taxation system. And the third and final one is a proportional taxation system. Let's start with your progressive taxation system. In the progressive taxation system, the average rate of tax increases as people earn more money. This means that the more you earn, the higher your tax rate will be. In the regressive taxation system, the average rate of taxation falls as income increases. This means that as you earn more money, your tax rate will reduce. In a proportional taxation system, the average rate of tax is constant. So the percentage of income that you pay out of your income stays constant whatever you earn. Let's have an example. Let's have three individuals, A, B, C, and they make money. Say their income is £100 for A, 200 for B, 300 for C. Now let's have different taxation systems: progressive, regressive, and proportional. Okay, with your progressive taxation system, we said the average rate of tax increases as people earn more money. So A might say pay 10%, B earns more, say 20%, C earns more, say 30%. Okay, with your regressive taxation system, say for instance we levy all these individuals a flat fine of just say £10. Okay, let's say we say each person has to pay 10 quid, right? For A, that would be 10% of his income, right? For B, that would be 5% of his or her income. For C, that would be 3.33% of his or her income. Okay, so you can see, you know, the more you make, the less your tax burden will be. Okay, the less your tax rate will be. And then for your proportional taxation system, say we say, okay, everybody pays the same rate regardless of what they make. Okay, all right, so the average rate of tax is constant. Okay, so your progressive taxation system, the more you earn, the higher tax rate will be. Regressive taxation system, the more you earn, the lower your tax rate will be. Proportional tax system, the tax rate stays constant. All right, very good. So your class activity for this week is to determine what taxation system do we have in the UK. So what sort of taxation system do we have in the United Kingdom, right? Figure this out and bring this to class. This is our class activity for the week. What taxation system do we have in the UK? So we have talked about the different types of tax systems. Now we're going on to the different types of taxes themselves. All right? There are two forms of taxes. You have your direct taxes and your indirect taxes. Okay? Now, what is a direct tax? A direct tax is a tax where the burden of payment cannot be passed on. Okay, so if you are taxed direct tax, you cannot pass this burden on to someone else. Okay, usually placed in household incomes, firms, profits, usually progressive. For instance, your income tax. If you're taxed in your income, you cannot pass this tax on to someone else. Or corporation tax, tax on profits, different from tax on goods. Okay, we'll talk about that later. Or capital gains tax, when you sell assets, shares, houses that have gone up in value. Inheritance tax, or your national insurance taxes. All these are direct taxes because you cannot pass the burden of payment on to somebody else. How about your indirect taxes? An indirect tax is a type of tax where the burden of payment can be passed on. And this distinguishes it from a direct tax where the burden of payment cannot be passed on. Okay, so what happens with your indirect tax is we might levy it to a producer, to a supplier, and then all the supplier or the producer would do would be to increase their prices so that the final customer who pays for the good ends up incurring the burden of tax as opposed to the person who we initially taxed. Okay, for example, this occurs on value added tax. Okay, when most goods or services are bought, say for instance you walk into Tesco, Aldi, Sainsbury, Iceland, and then the government taxes a particular commodity, right, as opposed to their profit, as opposed to incomes of you. What Tesco could do, or what the firm could do, would be to increase the price of that commodity. So you who ends up buying the commodity pays that tax as opposed to the company. All right. Excise duties as well, paid on specific goods and services like alcohol, or custom duties. Customs duties are also very good examples. Taxes paid on imports into the country. Okay, so if we increase the taxes on these commodities, all the supplier would do would be to increase the price of the commodity, and then the final person who pays for the item ends up bearing the tax responsibility. All right, so that's it. This concludes this lecture. Don't forget the class activity, and all the best.